There's a loan type that banks are quietly pushing on Americans right now, and it's one of the worst ways to buy real estate: personal loans for property. They sound convenient: no appraisal, fast approval, and less paperwork. Some people even think they're being smart by avoiding a traditional mortgage, but what most people don't realize is that these loans can cost you 3 to 4 times more than a traditional mortgage over the life of the loan. And if you're over 40, using one could quietly sabotage your retirement before you even see it coming. Give me 7 minutes and I'll show you exactly why I never touch personal loans for real estate and why you shouldn't either. I'm Michael Stone. I've spent over 8 years working in markets, banking, and personal finance, and during that time, I've watched people make the same expensive mistakes again and again. This video is about one of those mistakes. If you clicked on this, you're probably thinking about buying property, maybe an investment property, maybe a second home, or maybe you're just trying to avoid the hassle of a traditional mortgage. That instinct is understandable. But what I'm about to show you could save you tens of thousands of dollars. In my previous video, Dahlia Guzman wrote in from Colorado, and I appreciate you, Dahlia. If you're watching right now, comment your city so I can thank you in the next video too. Now, let's talk about why personal loans and real estate are a dangerous combination. First, let's be clear about what a personal loan actually is. A personal loan is unsecured debt, meaning the bank doesn't take your house, car, or any asset as collateral. They're lending purely based on your credit score and income. Because of that risk, they charge much higher interest rates, usually anywhere from 8% to 36%. A mortgage, on the other hand, is secured by the property itself. If you stop paying, the bank takes the house, which allows them to offer lower rates, typically around 6 to 7% for strong borrowers. Right away, you're looking at double or even triple the interest rate with a personal loan, and that's only part of the problem. What most people miss is that personal loans are short-term. Most max out at 5 to 7 years. Mortgages are typically 30 years. That difference alone completely changes your monthly payment. Even if you borrow the same amount, the personal loan payment will be dramatically higher. That's where the real damage happens. Let's put real numbers on it. Imagine you want to buy a $100,000 rental property. With a personal loan at 12% over 7 years, your monthly payment would be about $1,611, and you'd pay roughly $35,000 in interest over the life of the loan. With a mortgage at 7% over 30 years, your monthly payment would be about $665. Yes, the total interest over 30 years is higher, but the key difference is cash flow. That extra $1,000 per month with the personal loan has to come from somewhere: your paycheck, your savings, or your retirement contributions. Most rental properties don't generate enough cash flow in the early years to cover a $1,600 payment. That means you're subsidizing the property out of pocket every single month. If you're in your 40s, 50s, or 60s, that money should be going toward retirement, not toward supporting a poorly structured loan. Now, let's talk about what happens when things go wrong, because in real estate, they always do eventually. If you lose your job, a mortgage gives you flexibility. You have time. You can rent the property, refinance, sell, or work with the lender. With a personal loan, those high payments don't stop. Defaulting on unsecured debt destroys your credit, and there's no property to hand back to cleanly exit the situation. If the property needs major repairs, a roof, HVAC system, or foundation issue, a mortgage leaves you with breathing room. A personal loan leaves you stretched thin. One $10,000 repair can push you into credit card debt or force you to sell at the worst possible time. And if the market shifts and property values drop, a mortgage gives you time to wait it out. A personal loan puts you on a ticking clock that can force a loss. So why do banks push personal loans for real estate at all? Because they make more money faster. That $100,000 personal loan generates over $35,000 in interest in just 7 years. Banks would rather collect interest quickly than wait decades. They know most people won't do the math. They see fast approval and no appraisal and think they're getting a deal. They're not. They're paying a premium for convenience. Serious investors don't do that. They structure deals so the numbers work in their favor, not the bank's. So, what should you do instead? The first option is a traditional mortgage. Yes, it's paperwork heavy and slower, but the payments are manageable and the structure supports long-term wealth building. If you can't qualify, the second option is to wait. Save a larger down payment, improve your credit, and don't force a deal with the wrong tool. Real estate rewards patience. The third option is partnership. It's better to own half of a solid deal than all of a financial disaster. The bottom line is simple. Personal loans are designed for short-term needs, like consolidating debt or covering expenses, not for buying real estate. Using them for property is a structural mistake that can quietly destroy your cash flow and your future. Before we finish, comment below and tell me which city you're watching from. I read every comment. If this helped you avoid a costly mistake, hit like and subscribe for more straight talk about money. No hype, just clarity. This is Michael Stone. Your money works better when you understand it.